Good evening, everyone. This is Rodney with the Triton Wave Market Outlook for Monday, August 19th, 2013. As always, this is brought to you by my company, Triton Wave Consulting, which house the early warning market timing indicators called the Triton Waves that are used in all time frames in all markets by traders and investors all over the world. Okay, let's start off by looking at the S&P futures over here, continuous contract. The left-hand chart is the daily. The right-hand chart, let's make this a 144 continuous 24-hour contract, just to show you. If I scroll across here from right to left, all the way over to here, you can see that this marks. Now these are like about 5 or 6 hash marks a day. The 144 minutes. So if I scroll all the way over here, you can see that it only takes us to May 22nd. So it's like a May, June, July, 2.5 month view. This is a 2.5 month view, but I just wanted to show you how small this is. And then we're going to look at a comparison on the 987. And show you how far that goes across compared to the daily, which only takes us actually to August 15th, which is like a 3-day view. So you can make it increasingly smaller to take advantage of small moves in the waves, or you can look at a large picture like over here on the left-hand side, which I am going to now move out here so you can actually see better what's going on here. So keep in mind that the 144 came out to about here, and the 987 came out to about here. So if you're a long-term player, you don't want to watch the market every day. You want to take advantage of the larger time frame graphs. Okay. In the past 3 months, I've been warning you that these waves, this is T1, 2, T3, T4, and T5. So most of these waves have been generated by a policy push by the Fed, but the fib numbers just want to keep telling you it's higher, the white line, lower, and now lower. So the biggest thing about one of the things when you're using these waves is that you realize let's just scrunch this up a little bit. Is that when you have a move like this, you have a large move and the waves are moving higher and higher, and then you have a small move down like this, and a small move down here on the wave, but the longer wave stays above zero, and then they both move in unison above zero right here. And while this makes a new high on the futures, the waves, the top of this wave is up here, top of this wave is down here, top of the white wave is here, and then they both go below zero, which is happening right here. That is the biggest indicator of a move down, whether you're on a 55 tick chart, or whether you're on a 987 tick chart, or whether you're on a daily chart. And what I've been pointing out for weeks now is that once this is the divergence between the futures price and the waves moving down. So here we are. In past videos, I've said over and over again that we're ready to crack this. It happened this week, and now we're down here. And what I see happening is, let me move this out so you can see it a little better. It's now what time is it? 6:30 Central Time on Sunday, and we have already cracked this exponential moving average. This is the 55, this is the 89, this is the 144, and this is the 233. Okay, so the last time this happened, back in June, we blew right through on the 55, and the 89 came almost down to the 144. Now, the setup was not as rich as it was what it is right now. I mean, the setups were, the waves were a little bit higher here than they were here, but this, when it went below zero and came back up again, and now below zero, is very dramatic, going to be a very dramatic turn, in my opinion. So we have now the 8 and the 21 crossing on the daily, and we have the 55 pierced, and there's no big move up right now. It's up 50 cents, you know, down 75, up 50. No big deal. For what happened Wednesday, Thursday, and Friday, this is a no big deal retracement. If you're lucky enough to get this back up to the 1669, which I really don't believe is going to happen, but if you're lucky enough to get right in that area there, that is a load the boat. That's a short. That is a short. Right now, I think we're going to come down to 1632, bounce a little bit, and then come all indications from past short-term markets, like in the past year, they've come down to the 144 exponential moving average on the daily continuous chart of the ES. That puts us at right here, 1597. All right, let's look at this in the smaller time frame to see what kind of trades come up. Let's look at this on the 144. And I'm going to move this back here so you can see a comparison between the 144, not cash price, but you know, like day session price. This is day session on the left, and this is 24-hour session on the right. So you scroll across here with the cursor, and you can see the cursor moving on the left side. This comes out to 527, and 527 is over here. So this entire chart over here is, let me get a hash mark here. Okay, so this entire move on 24-hour chart right here only comes up to this on the 144-minute daytime chart. However, you can see, again, if you're a trader, forget this. If you're just like sitting there and putting in, you know, every once in a while you look at it, this wave goes down here, you're in here, you captured from here to here. On the upside, it's kind of like a little bit late, but very, you know, you're going to miss the first 20 points, but you're going to capture all this. Now we're going down, so it's time to get in, walk away, come back in a few weeks, and see where it is. More than likely, it's going to be down in this area here, around 1600. I don't know how fast it's going to happen, but if we look at this area here back in June, it happens pretty rapidly. And all these kickbacks, and mostly it happens out of, has nothing to do with fundamentals. It has to do with an overextended in the market. People starting to keep cash, and you can see how rapidly that happened. So that's over like this is over like a 15-day period. Not very long to go from 1450 down to 1350. That's 100 S&P points. All right, if we look on this chart on the right-hand side, actually let's look at that's a 144 minute. let's make this a 21 minute so you can see the comparison of what's going on here. The 21 minute sometimes works, sometimes doesn't work. I really like tick charts, but I'm leaving that up as a comparison. 987 tick chart. You know, this is like during a 1.5 day period. Some nice moves. I didn't play any of these, but whoops, wrong guy here. Hang on 1 second. Okay, down below 0, right here, bing. Up above 0, bing. Now again, this is kind of a late to the party for covering it, so what you want to do is you always look for the next lower chart, like the 610 or even the 377. Let's make this the 610 over here so we can see what we just did. Bing, bing, bing. Alright, so, whoops. So this chart on the right goes out to right here. The 377 goes to the 610 out here. So let's just mark that 610. So it's basically out here. So this whole chart on the right, sorry, is up to this marker right here. All right, so in that distance from here to here, if you're day trading and you don't want to watch, you know, you can watch this, but it goes down here and recovers right here. And this one, it comes up here after it crosses. And if you want to look at a smaller time frame chart to get out, you don't always want to get out with the wave that you started, because you're going to miss half of this. So you use a smaller time frame chart like this. If this isn't too clear, then you use this one, but you're out a lot closer to the high. Okay, let's look at something else. Apple computer. All right, I want to look at the daily on Apple and tell you what I saw last week. It was Apple when I looked at it. I looked at the 21, and I always look back. If I make a mistake, I look back and see where the mistakes were. So this is what happened. Last Sunday, it was basically looked right like that, and this looked like this. And I thought, looking at this, that because this was above 0, this was above 0, and this was moving up, and this was moving up, that this had a very good chance of exploding. And then I thought, well, the market's going down, and Apple's independent, so it may or may not go up. But then I looked at the 21, and I looked at this dip right here, and I saw that the T4, T5, T3, and T2, and T1 were all above 0. I thought it had a really good chance, before it went back up, to come back and hit the 441, the price of 441. And indeed, that would have happened, except for one thing. Before the opening of trade on Monday, Carl Icahn tweeted to the world that he was taking a very large stake in Apple. So what happened is basically history, and it doesn't matter what the waves are saying on the short term or long term. If some big player comes out and riles everyone or tries to wow everyone about his stake so he can pump up, or he or she can pump up the market with their investment, so they make money. They totally taking advantage of you. This spiked up like a bat out of hell. Boom. Completely negated that very short-term counter trend trade that I was looking for, you know, just down to here, and then it just took off. So thank goodness that happened right on the opening, so it saved me from making a call to the downside. So I was sort of vindicated, kind of like lucked out on that one. Didn't have ended up not having a position in it, and just watching it go to see where it would go. And it really did just take off. You can see up here, it's a little bit got a little bit weak when the 21 crossed. When the Apple 21, this is a continuous chart, but when the 21 crossed here, it got weak. It's sideways up, so it only captured another 5 or 6 points. We'll have to see on Monday what actually happens with this. T2 is now below 0, and I think the Dow is, if it rests, it's going to rest and then go down. It's not. This is not a V-shaped recovery. By no means is this market over on the downside, and eventually, Apple, whenever these waves start crossing, I'm going to turn this into a minute chart so we can see what's going on. Okay, so this crossed up. Oops, wrong arrow. So this started crossing up here right after the opening, which negated the call. That actually crossed 0 on the opening. So now we have this moving towards 0. There's a good chance that this might move up a little bit. If you're in it, maybe you want a few more points in it. If you're not in it, don't touch it with a 10-foot pole. When this comes back down here, boom, that probably will line up with a picture like this. And then this will come down to even, like a straight, just a straight line like that. Just a straight trend line. Okay, that's all I have, except for the fact that what I was reading today from Malden Economics is that this week alone we had a 4.1% increase in long-term bonds, which means that the bond markets are going down. And it doesn't mean they're at 4%. It was just a 4.1% increase, which is huge. So the way I look at it is that the yen for a long time, and still is, being used as a carry trade. And then when the U.S. Interest rates went down to 0, they're being used as a carry trade. And as a result, when the bonds start going up, these have to be unwound sometime. That means the free money that they've been borrowing is now going out of the stock market because, and hopefully it won't reach some kind of capitulation where the Dow is down 800 points in one day, because it'll scare the living crap out of somebody. But the free market, the free cash that all these companies have been borrowing, that eventually turn these into corporate earnings. So they're earnings, but they're not. I call them like fake earnings, but they pay huge dividends. At least dividends that people can live on. And they include like Kellogg's and Hormel and Smucker's and Hershey and Tyson. They're normally like defensive stocks with moderate PEs and good dividend plays. But if they're based on borrowing money cheaply, then the first thing that's going to come out when the money isn't cheap anymore is that dividends are going to be cut and these stocks are going to go down. So even the defensive stocks aren't going to be good here. All right, that's all I have. Good luck trading, and I will see you at the next update. Again, I want to remind you that I am Triton Wave, my company Triton Wave Consulting is has the Triton waves. I am at tritonwaveguy@gmail.com. If you want to get in touch with me, my name is Rodney Julian. I have a small elite customer base. I'm not looking for like hundreds of people to trade with, but just a couple dozen that I can shoot some emails to in a hurry and get in some of these trades, so you can make money as these waves indicate, long or short, and also with gold. Also, I didn't cover gold today, but gold is one of the mainstays of what I trade. Have a good weekend, and I will see you at the next update.